Back to journal entries.
Yay. I like journal entries.
Let's see. 11-3 is on page 467, 468. Again, you're given a list of transactions. You got to go through and do the journal entries. Okay? Same stuff you've been doing. Okay? Number one, do we need to go through each one of these? Do you want to go through each one?
Just quickly.
Yes, no?
Just quickly.
Okay.
Just quickly.
Number one, paid salaries of $10,000, additional salaries accrued but not paid $300. What do you think the entry would be? That's probably what it is. You accrue some, you accrue the $300, goes to a payable, you pay $10,000 in cash, and then your debit is salary expense. Number two, purchased equipment costing $50,000 by issuing a 3-year, 10%, $45,000 note and making a down payment of $5,000. So you got equipment, debit equipment for $50,000. You paid $5,000 in cash, $45,000 note payable, liability. Number three, billed users for services $100,000. $90,000 was collected during the year. $10,000 is expected to be collected during the second quarter of the next fiscal year. $10,000 due from other funds, right? It's other funds in this case because it's an internal service fund, but it's accounts receivable. 10,000 accounts receivable or due from other funds. 90,000 cash. $100,000 in revenue. Number four, incurred a probable loss from claims and judgments of $25,000. Nothing is expected to be paid for at least 2 years. That means you're going to book the expense and book a liability. Right? You're going to book a liability, just like you would. Right? For deferred revenue that you're not getting. Number five, no entry on number 5, ordered supplies with an estimated cost of $80,000. That would be a budget entry. We don't do budget entries for internal service and proprietary funds. Number 6, received half of the supplies at an actual cost of $41,000. A voucher was prepared and paid. $41,000 to supply inventory, $41,000 to vouchers payable, then you pay it with cash. Okay? And in most computerized accounting system, it actually does go through this vouchers payable account. It gets entered. When it gets entered, it goes to vouchers payable. Then when you actually cut the check, it gets paid out of cash. Okay? Number 7, supplies that cost $25,000 were used. Used means it goes to expense. Comes out of inventory, goes into expense. Debit expense, credit inventory. Number 8, depreciation for the year was $16,000 on equipment, $25,000 on buildings. Debit expense, credit accumulated depreciation. Okay? I'm sure you've done this before. Number 9, the first interest payment on the $45,000 note in item 2 is not due until the end of the first quarter of the next fiscal year. Prepare any required adjusting entry. You have to account for, right, the interest expense and accrue the payable.
45.
So 45,000 times 10% times 0.75.
Because it's the quarter, 3 quarters.
So it's 3 quarters. That's right.
Of the year, yeah.
That make sense?
Yeah.
Okay.
For the first quarter. Well, it's the first quarter. That's why because you're getting interest on the rest of the other 3 quarters. Because on 9.
Yeah. How far?
You're on the wrong page.
Is that good?
468.
More?
No, you're good.
I know, but it's from the entry number 2, right?
Mm. Well, you're taking the 10% from there, from the 45,000, and then it's only over the first quarter that you're doing the, or is it just the?
You're paying, it says in number 9, it says it's not due until the end of the first quarter of the next year. So you have 3 quarters in 1 year and 1 quarter in the next year.
Okay.
Does that make sense? Is when it's due. That's where you get the 3 quarters piece.
Because that makes us assume that it was done on April 1st?
Yes. Because otherwise, why would the interest be due the first quarter of the next year?
Because they're nice and let you pay it later? I don't know.
Yeah, I'm sure. All investors are nice and let you pay them later.
Okay.
Okay. Number 10. Sold equipment with an original cost of $28,000 for $10,000. Accumulated depreciation on the equipment was $21,000 at the date of sale. You got $10,000 cash, $21,000 accumulated depreciation on equipment. You're getting rid of $28,000 of equipment, and you got a $3,000 gain on the sale.
Just doing the math.
Okay. Any questions on those?
No.